Hey legends, quick video on balance of payments. You'll notice I take up the full screen this time, so feel free to stand back. I'm not going to run through a PowerPoint presentation here. I'm just going to kind of go through the key concepts of what the balance of payments is and just some visual tricks to, hopefully help to understand what it's all about. So what's important here, guys, is what is the balance of payments? Well, I want you to think of it like a document. Yeah, it's just like a piece of paper, yeah, that the government has, and all it does is it catalogs all of the international transactions. Full stop. Okay, so we put you like learning blinkers on, and I just want you to think of just the transactions that flow where money flows either in or out of the country. Those are the things that go in here. All right. So when you go and get your haircut from your local hairdresser, that doesn't go in the balance of payments. Okay, because money did not flow either out of the country or into the country. So that's point one. All international transactions. It's got to be international. The second point is this concept of debits and credits. All right, and this can be a little bit confusing. So I've got a little trick on how you can remember which is which. So what I want you to think of is when you use your debit card at the shops, yeah, the card that normally we just tap and go now, sure. But let's say you had your little piece of plastic and you used your debit card. Well, when you use that card, which way does the money flow from or to your bank account? Well, when you use your debit card, the money goes out. And it's the same thing here with the balance of payments. Okay, so if you're given a sample transaction and you want to say whether it's a debit or a credit, well, if the money flows out of the country, it is a debit. And if the money flows into the country, it's a credit. This is really confusing for those that study accounting because it's the other way in accounting. So I'm really sorry about that, but I don't make the rules. Just remember that little trick of when you use your debit card, the money leaves and it replies here with the balance of payments. Yeah, so when the money leaves the country, then that is recorded as a debit. It can be really hard sometimes to figure out which way the money goes when you're talking about a service. Yeah, it's really easy with a good. So let's say we're selling coal to China. That's really easy. We can be like, well, the coal's going over to China and the money's coming back in. So then that therefore is a credit. Yeah, because the money's coming in. But what does it mean when I don't know when Apple uh, issues dividends to its Australian shareholders. Well, again, the money comes in, so it's a credit. What about when Justin Bieber comes to tour Australia and the local promoter pays him into his American bank account? Well, the money has left Australia, so therefore it's a debit. So just follow the flow of money. So that's the second. The next one is, well, when we have the balance of payments, we split the classification of those into kind of two sections. Yeah, on one side we've got the current account, and one side we've got the capital and financial account. The way I like to visually represent this, and I'll go back a bit, is in like a seesaw kind of way. So you'll see here you've got the fulcrum in the middle for those who are into science. And on one side, you've got the current account, here represented by CA, and on the other side, you've got capital and financial account. Now, why I draw it as a seesaw is due to the nature of these two sub-accounts within the balance of payments. If one of them goes up, the other has to go down, all right? And for reasons I'll explain in a little bit. But I want you to think of these as a seesaw. So where we have the current account here, if the current account goes, oh, and sorry, this red line that you'll see along here represents kind of the balance between credits and debits. Yeah, money coming in and money going out. If we go below this red line, that's going to represent more debits, okay? More money leaving the country. And traditionally in Australia, we have a negative representation on the current account, meaning there's more debits than credits, and we normally have a surplus on the current and financial account, meaning there's more credits than debits. Okay, so I like to represent this as a seesaw because it kind of gives you that idea of when one increases, the other doesn't. By the way, why they work like this? Well, the current account, and let's just talk about what they both mean. The current account here represents all international transactions. Remember, this is all international transactions for both of these, but this one here are the international transactions with no future financial obligation. All right, I'm going to say that again. The transactions that go into the current account are all international transactions with no future financial obligation. Now, what this means is after this transaction that goes into here happens, there's no more future financial obligation as a result of that particular transaction. For example, when we sell coal to China, that transaction happens. The coal goes over to China, the money comes back in. After that, no one owes anyone anything. There's no future financial obligation of that transaction. And so therefore, it goes into this bucket. Now, when we go over to this side, um, for your current and financial account transactions, these ones do have a future financial obligation. Okay, so for these ones, you're going to have a transaction which is recorded in the capital and financial account, which does have a future financial obligation. For example, if an Australian was to build a factory in China, that particular transaction of sending the money over to China to build the factory, that is going to have a future financial obligation of a return of profit at some stage. Yeah, there is a future financial obligation on that particular transaction, and so therefore it goes over here. When you buy shares in an American company, yeah, that money is going to be leaving the country when you buy those Apple shares, but you're going to expect a return on those Apple shares into the future. So that since they have a future financial obligation, they go over this side. Now, why is it when the current account falls, the capital and financial account rises? Well, if on this side, we've got, it's really hard to do backwards, if on this side, we've got more money leaving the country than coming in, well, that's going to result in, like, think of it like a negative bank balance. So if we have, let's say, and I'll just do some dummy numbers, right? If we have, I don't know, $100 in credits and $120 in debits, well, where's that extra 20 bucks coming from? Well, it's going to come from over here. And how it's going to come over here is Australia is essentially, whether it's businesses or governments or individuals, are essentially going to borrow $20 from overseas to finance the deficit over on this side. And since that money is borrowed, that $20 from, let's say, a German bank account, a German bank, sorry, when that money is borrowed, well, it comes into Australia, doesn't it? And since it comes into Australia, it's represented by a credit. But that German bank is not just going to give us that money for free. No, that has a future financial obligation. Therefore, it goes on this side. Okay, so that's generally speaking the nuts and bolts of the balance of payments. There is the sub accounts, which are the five, I think, within capital and financial account, and then the four within the current account. A lot of students get really tied up on knowing the definitions and knowing all of those, and that's important, sure. The bulk of the current account, they're all kind of important actually, but don't burn too much of your time on getting those nailed. What's really important here is the understanding of those core concepts that I've just taken you through, as in which transactions go where, because there's lots of key knowledge points if you look further in the outcome on what is the effect of this thing, and there's lots of different things that it can be, such as change in the exchange rate or whatever, on the current account. Yeah, they'll say the current account deficit because in Australia we normally have the current account below the zero line, and so we have a current account deficit, which is where we've got more debits than credits, which is normally the case. Okay, how we do that we're going to talk about in future videos, but the core concepts of what is the balance of payments? Well, it's a recording of all international transactions. Okay, we then now split those into international transactions with no future financial obligation and those with a future financial obligation. And then the third point is, well, what is the relationship between these two things? Well, when we have a deficit here, we're 20 bucks short. Yeah, we've got more money leaving the country than coming in. And so how are we going to buy those, the difference between $100 worth of stuff and $120 worth of stuff? Well, we're going to have to borrow it. And where is the borrowing of that recorded? Well, that's over this side here. Some countries do have it the other way. So some countries have their current account, I might as well draw it, we've got time, have their balance of payments, like this. So they'll have it like that, yeah? Where on this side, capital and financial account, and then here is the current account. Yeah, so Germany is a net lender, for example, where they have more money leaving the country with a future financial obligation. Yeah, so they'll lend more money than they need for their balance on the current account. Neither one is good or bad, it's just different. If there's $100 worth in the economy that's been lent out on this side, well, then there's got to be $100 that's been borrowed on that side. So it's an equal relationship here. And that's the bulk of balance of payments. So if there are any questions, guys, feel free to reach out. It's a fairly tricky area here, so please feel free to watch this video again and shout out with any questions. Thanks, bye.